For Wall Street Media, I'm Mike, I'm here with Doug, and we'll help you make money in the stock market with information you can't find anywhere else.
I didn't punch you in the shoulder this time. I like to break things up a little.
Are you sure?
Okay.
All right.
Hey, we've got Rich Gordon.
Fixed income market strategist for Wachovia.
Yeah, I love Rich Gordon. Super wonderful guy, great American. He's usually a lot more bullish than I am, and he's got one this week that is, are there too many holes in the dam to plug? And he discusses the S&P index, right? Right now is at like 741. He says the next level of support for it for weekly close is 600 to 640.
Ooh.
And he says that unemployment, their economic team thinks unemployment might not hit a high until the third quarter of 2010. He thinks it'll be 9.7. Rich, I got $1, says it's higher than that. But he also says that Americans have been saving cash. Okay,
which is true,
for
I
the
think.
first time, for the first time in forever, and he's got great graphs and information up there.
Let's take a look at the clip real quick.
Hi, and welcome again to Market Summary Online. Last week, for the third week in a row, stock prices deteriorated, culminating in a sharp drop in the S&P Friday morning to 754 and closing still lower on Monday at 743. Keep in mind that there's good long-term support for the S&P at 741 on a weekly close, and through there, the next real support is until the 600 to 640 area. Investors are very nervous about the intended or unintended consequences of a potential nationalization of some of the U.S. banks, and the unknowns more than outweigh the opportunities right now. So we can easily see a technical breakdown on stocks that drives prices sharply lower. Consider the following data points. First, bank common stocks have lost over 50% this year. The sharp decline is being driven by fears that a conversion of government-preferred shares into common will significantly dilute or even wipe out the common shareholders. But the carnage for bank liabilities has also morphed into every portion of the capital structure. Financial preferreds are now trading at a fraction of their original issue price of $25 par. The yield in that index is now over 20%, which indicates that there's a high probability that the dividend payments will stop soon and for an extended period of time. Even bank senior debt has been meaningfully impaired despite the government's liquidity support programs. The CDS on the four largest banks in the U.S. widened by almost 120 basis points last week, and it's now 158 basis points wider than the recent tights reached in January. Second, we think that the sentiment and general trend on stock prices will be negative until the prices of banks' liabilities stabilize. We also think that bank equity and bond prices will be highly correlated because of the lack of clarity on the terms surrounding the post-stress testing capital injections for banks. After all, a government recapitalization of a bank's balance sheet could include a restructuring of senior debt terms. Hopefully, the members of the administration and Congress who craft the terms will be aware of this chart, which shows the correlation between bank stocks and the S&P. The first chart shows that there was a zero correlation between the two from May 2006 through February 2008. But over the past year, the correlation has moved to over 80%. This model would imply if broad conversions take place and the bank index fell by perhaps another 50%, the overall stock market would fall another 20%. That would be a bad outcome and cause even more GDP destruction and job losses than are already in the cards for 2009. The unemployment rate is at its highest level in 17 years, and Wachovia's economics department expects that unemployment won't peak until third quarter 2010 at a rate of 9.7%. Third, the headwinds for the general economy, as well as for stock prices, are substantial and made far greater by a key structural shift in consumer behavior. Americans are worried about their financial future, and as a result, they're saving a higher percentage of their money. The chart shows the personal savings rate as a percentage of disposable personal income. Here are some observations about the chart. First, the savings rate had been in decline for a long time, but that decline accelerated in the mid-1990s. This probably has a lot to do with the growth during that period of tax-advantaged savings mechanisms like 401k plans, IRAs, and 529s. The problem is that these vehicles carry the price risk of the broader markets. They're a great way to save for retirement during bull markets, but deliver the misery of wealth destruction in bear markets, which we're obviously in right now. Without the savings tailwind that the bull market used to provide, people are left to secure their financial futures the old-fashioned way, by earning money, not spending all of it, and putting that savings aside in very low-yielding but safe bank accounts and money market funds. Second, the savings rate actually became negative in 2005 and remained virtually zero for several years after that. This compares to a long-term average savings rate of 6.5% since 1970. It's risen sharply over the past 5 months to 3.6% because people have been cutting down on their non-discretionary spending, which is part of the reason for the very sharp slowdown in economic activity during the fourth quarter last year and year-to-date in the first quarter. Rebuilding the savings cushion is going to take time and act as a drag on economic activity while it's happening. But it will also help to create a more stable and sustainable platform for the economy in the future. We believe that while it's painful in the short and intermediate term, it's necessary and unavoidable consequence of the over-reliance on cheap access to debt that had fueled consumer behavior over the past decade.
And we're back.
Rich Gordon is wonderful. This is a great asset, and this is a great thing that we do, bringing this to you. You should enjoy this, appreciate this. He's highly respected, and you'll see why.
Great. We're here every day at Wall Street Media. You can find us directly at wsmco.com. Thanks.